Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Let's transition to another story, Matt. And, we talked about this.
We've talked about it so many times.
So many times.
We continue to get this story on the Bloomberg terminal. The U.S. government is considering asking a federal judge to force Google to sell off parts of its business. The last time we had this story, it was people familiar. Now the department.
We've got a filing.
Has confirmed it. Of course, there are other options as well, and we're not going to get even the beginning of this part of the trial until spring of next year. But I want to bring in Leah, Nylen, as well as Mandeep, Singh from Bloomberg Intelligence here to talk about this. Leah, we've got, there's a lot of time between now and when this sentencing, maybe not the right word, but this part of the trial is gonna start. What kind of breakup is the federal government gonna go for?
Yeah, so that remains a question we'll find out next month. So what they filed yesterday was what they called sort of the menu of options that are on the table for the judge. And so at the one end is a breakup. And they have said that they may consider asking for forcing Google to sell off either Chrome, Android, or Play. And probably if it was Android, it would be Android and Play, because Android is the operating system and Play is the the app store that goes with Android. And that's sort of like the extreme end. In the middle, they sort of had these options to sort of force Google to share a lot of the information it scrapes from the web to make its underlying search results. And the government said that if they do that, that could be used by other search engines. It could also be used by AI startups who sort of need this data to sort of create their models. And then the sort of like wimpiest one is, just sort of ending the contracts that the judge found to be illegal. These are the ones in which they paid other companies like Samsung and Apple billions of dollars to make their search engine the default. So these are our options, and they're going to officially, set down what their request is in November. And then the judge is going to let them do some more discovery, asking Google some questions about how this would impact their business. And then we have our mini trial in April. And then the judge said that he will issue his decision by August of next year. So we still have, how many months is that? 8 or 9 months before we get to the end of just this part. But it's a big deal.
A lot to look forward there to. Mandeep Singh, come into this conversation. You take a look at Google shares right now, currently off by about 2.4%. When we were looking at it in the morning, which feels like a long time ago, it was pretty much unchanged, but now taking a leg lower. Put this into context for us. Of course, there's a lot of wood to chop before we get to any real action, but how much does this matter to Alphabet? How much does this matter to Google?
Look, some of the remedies that were suggested in terms of forced sale of Android or, some of the businesses that they own, Chrome browser, I think is just so unlikely simply because the way Google is run, it's all one shared infrastructure that's powering YouTube, that's powering the browser, that's powering the cloud business. How do you take an entity out? And so the one, area where there's another lawsuit, DOJ lawsuit on the ad tech.
There's so many lawsuits, dude.
Yes,
there's one on the ad tech marketplace. There's a bunch of states that are suing. They
on
want
the
Google to pay for telling you how to
tech.
switch your browser. Yeah. There's the EU. Obviously, Margaret Vestager is going to decide by the end of the year. She says breaking it up is the only solution she can imagine. I'm forgetting. There are other lawsuits.
Yeah, there's
here.
a bunch.
Yeah, there's
and
at least
the common
5.
thread I find across all those different lawsuits, the most commonly pointed issue is their ad tech stack, which is where I feel like you could make a case. Why does Google own, the supply side ad platforms, the demand ad platforms, the marketplace? And then it has a pricing advantage. Everyone can see that. And that was built on their DoubleClick acquisition back in 2007. So you could say they didn't build this organically. It is something they acquired, and then over time they really had an advantage. But they've
tuned it up.
They did, and that you could say that even Android was an acquisition, YouTube was an acquisition for Google. So they've tuned all these things up over time. But I think ad tech is the one that is the strongest or the most convincing, at least to me, out of all the things they are offering as remedies. I can't imagine, Google for sale of Android or, all these products that are integral to their LLM strategy. I mean, that's the future. So
Leah, what do you think? I mean, first of all, we haven't seen a big breakup in the U.S. since, none of us was born except for me.
Not even, okay.
When Ma Bell got broken up. And then, second of all, this is like a national security issue. Not only is Google dominant in search, but America's Google is dominant worldwide. Do you ever talk to anybody in your reporting who says, Google is a champion? How could we break it up?
That is a point that Google likes to make, that by breaking it up, it might make it less competitive, particularly against China. I will tell you the antitrust enforcers are not particularly persuaded by that. They don't like the idea of supporting a company simply because it's a national champion. I mean, America's competition policy is built on the idea that the more companies we have competing, the better products and services we have for consumers and for other businesses. So they would say, maybe we don't really care that this makes Google a little bit less competitive globally. We want there to be other businesses.
And I'm just curious. I mean, as a reporter, you cover antitrust, you cover, of course, the DOJ, you cover the FTC. It just feels like the antitrust landscape over the past few years has really gotten more aggressive, more emboldened. And just talk to us about that, about how your beat has changed before your eyes when you think about, just the last couple years.
Yeah, I have been on the antitrust beat for 12 years, and I have to say, when I first started, I never expected that the stories I was covering would be on the front page of the New York Times. Definitely, the Biden administration really took this as the thing that was going to differentiate themselves from the Obama years, because the Obama years were sort of seen as very beholden to business. They didn't do any of the things against the tech companies, and they feel that was a big mistake. So Biden brought in a trio of very aggressive enforcers: Jonathan Cantor at the Justice Department, Lina Khan at the FTC, and Tim Wu at the White House. Tim is now gone, but Lina and Jonathan are still there, and they are still making moves. The Google trial just ended a few weeks ago. They just sued Visa. And the FTC, just sued a bunch of the pharmaceutical benefit manufacturers. So they have been more aggressive in the past 3 years than people had been in the last 4 decades. It's very much a conscious decision on their part to sort of reject the more laissez-faire capitalism that they say was brought in by the Reagan years, and they feel did not do very well for the average American consumer.
And Leah, I think we're 26 days away from the presidential election, if you can believe it. And it's, especially among the Wall Street firms that we talk to, the Wall Street guys and gals that we talk to, there's been a lot of frustration that it feels like you can't get a merger done, that with this FTC, with Lina Khan in charge, it's been really, really difficult to get any deals done. At the same time, J.D. Vance, we know, has had nice things to say about Lina Khan in the past. When you think about
what does that mean, that J.D. Vance loves her?
I don't know. I want Leah to weigh in here, because you think about the change in administration, even if Trump wins the White House, are you expecting much change when it comes to the antitrust beat?
It's a little bit hard to say, but the answer is not on tech, because a lot of these cases, including the one that we're talking about right now, Google, was actually brought during the first Trump administration. So the Trump administration and Republicans like J.D. Vance really don't like the big tech companies. So I can't really see them pulling back on any of the cases that the Biden administration brought against the tech giants. Where you might see change is definitely in the merger area, because you do hear a lot that while the Republican folks maybe like what Lina Khan has done on big tech, they're not as thrilled with what she has done in the merger area, sort of chilling mergers and making it more difficult for businesses to sort of go about their regular business.
I want to also point out that being on the Bloomberg top page is just as good as the front page of the New York Times, Leah. So you should be proud of the entirety of your career here. Mandeep, I want to ask you about the stock, obviously, at Bloomberg Intelligence. Most people are going to follow your research to see how that does on the equity side. It's up over the last 5 years, 170%. It hasn't done great this year compared to the S&P, but compared to the other FANG or Mag 7 stocks minus NVIDIA, it's holding with the pack.
Well, I mean, I think there is a clear overhang when it comes to the antitrust side of things and the scrutiny that Alphabet gets. But when you look at the sum of the parts, even in a worst case breakup scenario, you could argue the sum of the parts for Alphabet is way more than, its current valuation. And it's just driven by the fundamentals of the cloud business, the YouTube business, the fact that they have a native LLM advantage that even Microsoft doesn't have. Microsoft is reliant on OpenAI for the LLM. So I think given everyone is so fixated on generative AI and LLM, that's why all these products are core to Alphabet as a franchise, when it comes to them deploying their LLM on the cloud or on Android. And I think it's a huge competitive moat.
All right.
Okay. Thank you very much, Mandeep Singh, coming to us from Bloomberg Intelligence, and Leah Nylen, sometimes on the front page of the New York Times, maybe, but definitely on top go, Bloomberg News.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Now, we've been talking about commercial real estate as if it's the next shoe to drop for a couple of years.
Oh, yeah.
And even lately, we've gotten sort of warnings from people involved in the industry. I think
Khosla, for example.
Exactly. Victor Khosla, the founder of credit investor Strategic Value Partners, recently said there are problems galore. He says there's a tsunami coming, but he's talking specifically about office, right?
U.S. offices.
And there's not only big regional differences, but also, if you are investing in student housing, you're doing fine right now. Medical is, still obviously a thriving business. So let's bring in an expert right now. Mark Gibson joins us in the Interactive Broker studio here at 731 Lex. He is the Americas CEO of Capital Markets for JLL. I know them as Jones Lang LaSalle. Have you gone through an official name change? Is it just JLL now?
JLL.
Okay, but you have really an incredible seat from which to watch all of this that's going on. Where would you say we are? Say if it were a baseball game, right? And, the fall of commercial real estate was in which inning would you say?
That is a hard question to soundbite, Matt. But let me back up for a minute, because you started out with a tsunami of issues and you limited it to commercial office. But in reality, when you step back a minute and you look at, in general, what has occurred in commercial real estate, and there has been some cynicism around, any kind of risk that might be out there for a financial institution, systemic risk, or things like that. But in reality, what has caused this is a fast increasing cost of capital. So the demand has largely been there, including, ironically, in office.
Although it's shifted, right? It's come out of the city centers and gone out to urban.
It's
suburban.
actually reemerging, and it is very different story geographically, so it's hard to soundbite it and talk in global discussions. But in general, it hasn't been a demand issue from a commercial real estate standpoint. It's been a cost of capital issue. So when you think about the Fed's recent actions, and you're an investor, and you're worried about inflation because you're concerned if you invest today and the cost of capital increases, you might look somewhat early. So you want to wait and see if that's really going to be conquered. The investor community today believes the Fed is indeed going to conquer inflation. Okay? And it may take a little bit longer because we have government stimulus in terms of building back infrastructure and things like that. But generally speaking, monetary policy has worked. And so then when you have a normalizing yield curve, so if the issues, and there have been limited relative to what was discussed earlier in the year, problems in commercial real estate because demand has not waned, it was due to the cost of capital. When that starts reversing,
right,
then real estate, by and large, and it's different for different product types, self-corrects.
Yeah, well, just focusing on U.S. office, it's interesting to hear what you're saying, that this is a cost of capital problem, because some people might make the argument that, no, this is structural. Life changed during the pandemic, and the U.S. office market is different now. There's people who, are doing hybrid work, and that's a trend that's here to stay. It sounds like you're making a different argument.
No, I think it's a valid point. I do think that what I was talking about is in general. Commercial real estate was thrown, to Matt's point, into one basket and discussed globally, which you really can't do. You have to back it down by product type. But on office specifically, the data would suggest otherwise in terms of what is currently happening now. So when you look at occupancy by card swipes, and you look at the vibrancy of New York, for instance, and you see what is happening in the marketplace, it's a very different story than what we have been talking about for some time. So we think that office
it's not as
is
bad,
going to have
issues.
It was well, it is of all the product types, it will have issues for a host of reasons. We don't have time today to really go through it, but it will have more issues than other sectors in commercial real estate. But nonetheless, it's not where people believe it is from a distress standpoint. There's going to be quite a bit of distress in the space, but it'll be a have and have not scenario. The better buildings are doing quite well. In fact, some of them are doing better than they have ever done in U.S. history, and then others aren't. So of all the real estate classes, it's the largest divide of have
At the same time, it seems like there's a flood of capital that wants to get in. We talk about private credit more often than we talk about commercial real estate. Is there so much money there looking for a home that it helps ease the blow a bit?
Yeah,
soften the blow?
it's a good view, Matt. What really is happening is there's no lack of liquidity for commercial real estate. And the fact of the matter is, if you buy good real estate and you don't over leverage so you can survive cycles, it goes up. And it's a good long-term store of value. So people are looking at the right entry point to get into commercial real estate across the board. There's no lack of liquidity. It's been the cost of that liquidity that has been the issue of late. But now we're having you said a light switch went on. It almost is a light switch in terms of what has occurred. So the amount of capital that wants to invest in commercial real estate is substantially higher than it was. And at the same time, you have people that are looking to absorb that capital and are willing to accept the cost of it and the various risks. So we're seeing a bid-ask gap narrow, which is why transactional volumes have been muted somewhat in commercial real estate, where we're beginning to see that tick up.
And we have only about a minute left with you, Mark. We have to have you back for a longer conversation, but talk to us about magnitude when it comes to the cost of capital coming down. Of course, the Fed has started on their rate cutting cycle. A lot of questions about the trajectory, though. I mean, how much do rates have to come down before you really see activity accelerate broadly?
I don't think much, Katie. It's a good question. Real estate investors tend to look longer term, so they're looking at the 10-year bond versus necessarily the short end of the yield curve. But nevertheless, as you see a normalizing yield curve, you will have more transactional activity. We're already beginning to see it, but no one is betting on that to have any significant impact across the commercial real estate industry.
All right, Mark, great conversation. Really appreciate your time, of course, joining us in studio. That is Mark Gibson. He is America's CEO of Capital Markets, talking to us about real estate, the commercial real estate market, the cost of capital, that 10-year Treasury bond currently camped out at about 4%.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about nuclear. We're talking about a lot more these past couple weeks. Of course, you think about Microsoft's announcement to partner with Constellation Energy, reopen 3 Mile Island. It, of course, has breathed a lot of life and excitement back into nuclear, back into uranium. Let's break it all down now with John Kotek. He is Senior Vice President of Policy Development and Public Affairs over at the Nuclear Energy Institute. John, it's great to have you with us. Matt and I have spoken to the CEOs of a couple of different uranium miners in the past week or so, and the question I keep asking them is, what does this moment feel like? Of course, it feels like there's been broad support for nuclear for a while now, but we were looking for a catalyst. Now we have one. How would you describe this moment?
Yeah, well, first, thanks for having me. I describe this moment as a long overdue recognition of the value of nuclear energy as part of a clean, reliable, and affordable energy system. What's happened in the last few years is as companies focus more and more on reducing the carbon intensity of their energy production or their energy use, they come to recognize that having something like nuclear power that's available 24/7, that can run 18 to 24 months at a time while producing carbon-free power is enormously valuable. In addition to things like the job creation, the tax base, the other economic benefits that come from nuclear power. We're seeing a moment where people are recognizing that it's really important to both keep the nuclear we have and get on a path to build more.
I wonder about the affordable part of that. I mean, nuclear is clearly, there's no carbon emissions, right? You only have to deal with the waste, and we can talk in a bit about ways to deal with that. The affordability part is what always dogs me when I talk to experts like our reporter, William Wade. Is it really, can we really get there? Because it seems like the costs, the initial layouts are so high.
Yeah, and so great point. There's a couple of things you need to recognize here. One, yes, the initial layout is high, and frankly, when we built the nuclear power plants that we have today, right, they cost more than the coal plants, for example, that were being built at the time. But they become an asset that's available for 60, 80, even 100 years. And once you've paid off that initial construction loan, what you've got is an asset that's producing very affordable zero carbon power. And so it really is something that is almost a gift to future generations. We're benefiting from the investments that were made in the plants that we have today back in the 70s and 80s. Future generations should benefit from the investments we make today. So that's one part. The second part is you've got to distinguish between the cost of a particular resource and the system cost. And what I mean by that is, look, we're going to build a lot more wind, we're going to build a lot more solar. But because of the intermittent nature of those technologies, to run a whole grid using just those technologies, you have to enormously overbuild both those technologies and the storage that's needed to carry you through periods where you don't have the wind or the sun that you need. You also need to build out enormous amounts of transmission, which is very difficult to get built. Nuclear helps you avoid having to do that. And so even though that particular increment of nuclear generation might look more expensive than a solar farm, for example, on a system basis, by having nuclear, you can avoid a massive overbuild of these other technologies and ultimately save consumers money. And what matters at the end of the day is what are consumers paying.
And of course, you're talking about expenses here. Something that Matt and I have been talking about over the past couple of weeks is just the timeline. Of course, the point has been made to me that spinning up and turning back on these nuclear reactors, it's not like switching a light switch necessarily. So even with all of this momentum, of course, you have Google too thinking about using nuclear to power their data centers as well.
And Amazon.
Exactly. I mean, you have to imagine all the big tech companies, reported or not, are looking at this. So, I mean, my question to you, John, is what kind of timeline does it take to actually spin up some of these?
Yeah, so as we look down the road to some of the new technologies that we're looking to bring online, those should be able to be constructed in a much shorter period of time than we've seen historical nuclear power plants built. If you look at the experience in Japan, for example, about 20 years ago, in South Korea more recently, they were building large reactors in about 5 years. Okay? The experience here in the US has been significantly longer than that, but that's because we haven't had a sustained program of new build. These are big machines, they're complicated. And so the more that you have experience building them, the better you get at it. We've even seen that with the two new reactors that came on in the state of Georgia recently, called Vogtle Units 3 and 4. As they went from Unit 3 to Unit 4, they saw a 20% reduction in cost and a 30% increase in efficiency in the construction, just from the learnings going from one unit to the next. If we can start building these things at scale, we're going to get very good at them and we're going to shorten those timelines.
It's an interesting point about the expertise needed. And of course, nuclear, it's a really exciting time. I mean, you put AI, you attach that to anything, and suddenly it's very exciting. I'm curious what talent retention and recruiting has been like over the past couple decades since, again, nuclear, it's been waiting for a catalyst, but it's been waiting for a long time.
Yeah, and what we've seen is that we can attract nuclear into, or we can attract people into nuclear jobs in large part because people recognize these as very long-term careers and very well-paying careers. So when I've asked leaders of organized labor, for example, about their concerns in finding the workers to serve as, the electricians or the construction workers, what have you, in these facilities, they say, show me the jobs and I'll find you the people, because the people see these jobs as a pathway to the middle class. They see a safe job, they see a long-lasting job, right? These reactors can run 60, 80, we think maybe up to 100 years, okay? So the type of facility that you can build a community around, the type of career where you can set down roots in a particular community. So we think as these projects move from the planning stage into construction and operation, that will be very competitive in bringing new workers into nuclear.
I want to talk about, I always talk about the Bill Gates documentary on Netflix. I'm sure you've seen it as well, Inside Bill Gates' Brain. He talks about small modular reactors and new technology that allows you to reuse the waste in terms of reuse spent fuel. And this has obviously been one of the big problems with nuclear. When you get the spent fuel, you've got to bury it under like the Cheyenne Mountain Range or something and leave it there for the rest of eternity. Is there a solution to that?
Yeah, so first to the Bill Gates thing, I'm really excited about that technology. I actually worked at the facility in Idaho where the predecessor to that technology was demonstrated. And so it's really exciting to see that going into commercialization. I should point out there are actually several other reactors, both here in the US and in Canada, where construction has started on building next generation reactors. So that's all very exciting. In terms of the waste question, it's important to recognize that the waste generation from nuclear is very small. If you or I got our lifetime of energy, not just electricity, but total energy from nuclear, the waste from that could fit in a Coke bottle. Okay, so it's a small amount of material. We also know where it is, right? It's very well accounted for. The facility I worked at in Idaho had several spent nuclear fuel storage sites within a couple 100 yards of my office. So we know how to manage this. It's straightforward. You put the material after a sufficient cooling period into a concrete and steel overpack, and you can air cool these things. That part's not difficult. Ultimately, we are going to need to find a final resting place for this material. Fortunately, we know how to do that too. You want to put it into a stable geologic environment, maybe 1,500 feet underground. Our friends in Finland have developed their repository. They're in their testing phase now. Sweden has selected a site. Our friends in Canada are down to 2 sites to host such a facility. So other nations are moving forward. We know how to do it.
I would just shoot it off into space, John.
It's funny you mentioned that. People actually considered that back in the 50s and 60s, and then the space shuttle blew up. Oh. And that idea.
That would be bad.
Yeah. Okay, yeah, that would be bad. But so other countries are moving forward with this. We are at a political impasse here in the United States. I should note that funding to pay for this has been collected. The government put a 1/10 of a cent charge per kilowatt hour of electricity generated from nuclear, a tax on spent nuclear fuel. As a result, there's more than $45 billion sitting in the Treasury to pay for this when we can get Congress and the administration to agree on a path forward.
And John, I mean, we've been talking about Microsoft, Alphabet. We've been talking about Amazon, and I made the point that, reported or not, probably all of these big tech companies are talking about partnering with nuclear providers in some way. I mean, are you seeing that in your role, at the Nuclear Energy Institute? Again, you're SVP of Policy Development and Public Affairs. I mean, what sense have you have of the conversations that are going on in the industry right now?
Yeah, absolutely. As more and more companies focus on decarbonization, they're coming to nuclear. And so the big tech firms that you mentioned. Another thing is oil, gas, chemical, steel, pulp and paper, a wide variety of companies that need not just clean electricity, but also need clean heat. So nuclear power plants run at high temperatures. Next generation reactors, like the Bill Gates one we talked about before, will run at even higher output temperatures. As a result, that can serve as a source of process heat to help clean up some industrial processes that currently might rely on coal or on natural gas as their source of heat. So I think you're going to start seeing more than just the tech firms, but companies like Dow, which has partnered with a company called X Energy from Maryland to build a gas-cooled reactor in Texas to help provide carbon-free both heat and power to clean up that facility. So a lot of opportunity.
I got to cut you off, unfortunately. Katie and I could talk to you about this for hours. Truly fascinating. And I didn't even get to ask you if it's annoying when people say nuclear. But thank you so much for joining us. John Kotek from the NEI.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, this is Bloomberg Businessweek. I'm Katie Greifeld alongside Matt Miller. Of course, we are filling in for Tim Stenovec, Carol Massar on their way to Los Angeles. And they're missing an interesting market. Of course, we are less than 20 minutes until the closing bells. Of course, we have green on the screen when it comes to the S&P 500, currently up about 0.7%. We'll see if it can hold it for the next 18 minutes or so. But let's zoom out and let's talk about these markets. We're going to do that with Max Wasserman. He is the co-founder and senior portfolio manager over at Miramar Capital. He joins us from Northbrook, Illinois. And Max, of course, we are counting down to those CPI figures coming out tomorrow morning at 8:30 a.m. Eastern. You think back to what we learned on Friday when it comes, of course, to the U.S. labor market. There was a little bit hotter than expected wage growth. That seemed to spook the bond market a little bit. And Max, it seems like that has raised the stakes a little bit for the CPI numbers that we're getting tomorrow. Where do you stand when it comes to whether or not, we can kind of look past them, focus on all the good noises coming out of the economy, or whether, this could be an issue for the market?
I think it's going to be a short-term issue if it comes in hot, because then you may not get another 50 basis points that everybody's anticipating. But the Fed is telling you it's easing rates. They're seeing, the long-term trend of the CPI coming down. So you may have some hiccups along the way, but they're not going to go 50 basis point cut, then turn around and hike it. So they just may do it 25 basis points. But I think they're going to cut it around another 180 basis points in the next 12 to 18 months, because if you have the Fed funds rate around 480 and they're anticipating the real trend on CPI is under 3, that gives them almost 200 basis points to bring it down.
What if we get a jump in inflation? Are you concerned at all about that? Because with the labor market doing well, if inflation starts to look concerning again, maybe they won't hike, but they could skip a meeting.
Yeah, they could. And I think that's a short-term look, and that would spook the market a little bit because it's running on such optimism right now in light of all the catalysts that are out there. But if you still look at the long-term trend is they're going to cut. So I think they're still going to do a quarter and then maybe slow it down, or they may just say, we'll skip it and see more information. There's a lot of other things. You have the hurricanes and what that's going to disrupt the economy. You have what's going on with the strikes. You have what's happening with Boeing. There's a lot of issues out there. So I'm not convinced that they're going to stop cutting just because you have a slightly higher CPI. And I do expect, by the way, that inflation is going to be much more stubborn. I think the Fed was too aggressive, in my opinion, to go 50. I would have preferred they go quarter points along the way and let the data come in. But given the fact they already made a commitment to 50, it'd be very hard for them to slow down too drastically.
Well, it's interesting to sort of think about the different factors there. With the strikes, of course, any one union probably isn't going to show up in the national numbers, but you add them all together and you could say that maybe that's going to keep the pressure under wage growth for a while. And then you think about the hurricane, and this is a conversation we've had with our own Mike McKee, that, of course, hurricanes are horrible events and they're natural disasters, but the cold economic fact is that you have, of course, the rebuilding effort that comes after, which leads to an uptick in economic activity. And I guess I'm wrapping this all together for a question that is basically, do you think that there's risk that the Fed sort of overheats the economy and we see a bit of a melt up in the stock market?
Yes, I do, because I think the euphoria based on the Fed cutting drastically, they're looking for maybe another 50 to a quarter by year end, may be much too optimistic given what's actually happening. I think the Fed is behind the curve so many ways. They were behind it when they were raising, they were behind it when they're cutting. But with all the data that's out there, there's no clear-cut picture that says that CPI and inflation is going to drop right down to 2%. You do have strong employment. You do have a lot of catalysts that drive the economic recovery that we're going to experience with the disasters that you're going to see in Florida. But I think the Fed has made such a commitment with that 50 basis points. I think it was such a strong statement that says they want to cut rates because they think the long-term trend of inflation's down. So I don't know that a small-term hiccup, inflation ticks up, is going to spook the Fed or to change their policy. I think they'll just slow it down. But they're leaning to cutting, and I think they're going to do it over the next 12 to 18. What they do in the next month or two, that I don't know, but 12 to 18, they're going to cut rates. So
that would, I guess, help smaller cap companies. In terms of the large caps, we know, the AI play has been energized for so long. Energy, because of AI, and because of maybe what's happening in the Middle East, pushing prices higher, has also been a good bet. And of course, if you look at what's going on in the Middle East, I guess defense stocks also could be a good bet. But what about small caps? I mean, as the Fed cuts, are the companies on the Russell 2000 going to be doing better and better?
I think money's going to move around. And should they do better? Yes. I think lower interest rates would lead the market to go to small caps just because the large cap tech play has been done. And I think it's a little extended, to be candid. But I think the whole market will spread out. I think you're going to see it in the market spread out from just the strong, large cap tech, and you're going to see the mid caps. I think you're going to see the whole broader market take advantage of it as money will go to where it's treated best. And at these multiples of technology, I don't think it's going to be treated that great going forward for the next 6 to 8 months. But you could see it in other areas of the market with lower interest rates. But in order for that to happen, you need interest rates to really come down a lot more than they currently are. Because money markets right now are still giving you 4.5%. The move that I think you need for even a broader, stronger market is you need another 50 to 100 to come out, where money markets are basically under 3%. Then people will be taking money and looking for more aggressive plays to get cash flow, to get growth.
Max, it's a great point. Of course, it is hard to break up with cash when we're still talking about yields of 4.5% or so. Definitely a difficult sell there. But you talk about rates coming down, benefiting the market broadly. But I would like to get specific here because in your notes, you talk about specifically the housing market, consumer discretionary stocks over the next 12 months. I mean, name some names here. Who do you think specifically will benefit?
Well, sure. I mean, now it's, in fact, what's happening with the hurricane, everybody's looking at the Home Depots and the Lowe's. We have investments in Home Depot. But I'm looking at it, if rates are going to come down over the next 12 to 18, and the market's going to forecast that, you're looking at home improvement stocks. If mortgage rates are coming down, people are going to be more apt to refinance and go somewhere else and buy new homes. Or they're going to do home improvements because rates are lower. So to me, the Home Depots of the world, the Lowe's, would tend to do much better, even though they're trading at 52-week highs now, given what's happening. And also any rebuilding would do that. I think the consumer would do better because if they're less strained on higher interest rates, if they have more freed up capital, I mean, you're going to see that like in a McDonald's, you're seeing, I mean, they're becoming very successful with that $5 to $10 Happy Meals that they're putting out. So I look for those type of companies. Another one we like is General Parts because people are keeping their cars longer and they're going to do the repairs on them and they'll benefit for that because they own the Napa stores. But anyone that puts more pocket in the consumer will ease up the pain that they're experiencing with inflation. So it's not just interest rates coming down, it's also costs coming down.
All right, Max, thanks so much for joining us. Max Wasserman there, co-founder and senior portfolio manager at Miramar Capital.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.